Hi. Let's learn about arm's length transactions. An arm's length transaction refers to a business deal in which buyers and sellers act independently without one party influencing the other. In simpler terms, it means that both parties act in their own self-interest and are not subject to pressure from the other party. They also assure others that there is no collusion between the buyer and seller. In the interest of fairness, both parties usually have equal access to information related to the deal. Arm's length transactions are commonly used in real estate deals because the sale affects not only those who are directly involved in the deal but other parties as well, including lenders. For example, if two strangers are involved in the sale and purchase of a house, the final agreed-upon price is likely close to the fair market value, assuming that both parties have equal bargaining power and the same information about the property. The seller would want a price that's as high as possible, and the buyer would want a price that is as low as possible. Otherwise, the agreed-upon price is not likely to differ from the property's actual fair market value. Family members and companies with related shareholders generally don't engage in arm's-length sales. Instead, the deals between them are non-arm's length transactions, also known as arm-in-arm transactions. This type of transaction refers to a business deal in which buyers and sellers have an identity of interest. An existing relationship tends to influence the terms of a non-arm's length transaction, which can impact taxes and other financial considerations. One of the main benefits of arm's length transactions is that the transaction is fair and equitable, especially in real estate deals. The terms of the deal accurately reflect market conditions rather than being influenced by other factors. FMV is the best possible price that a neutral and impartial seller and buyer are willing to accept and pay to close the deal. Factors used to determine the FMV of a home include location, amenities, and comparable homes, among others. Let's use a hypothetical example to show how arm's length transactions work. If a father is selling his home to a stranger at the fair market value, it would be considered an arm's length transaction. However, if the son wants to buy the house for a lower price, it would be considered a non-arm's length transaction due to their existing relationship. Here are two key takeaways. 1. An arm's length transaction is a business deal that involves parties who act independently of one another. 2. Deals between family members or companies with related shareholders are not considered arm's length transactions. Hope this would help. Thanks for watching.